Welcome to the next video of the module devoted to international trade, in which we will be talking about the importance of international financial markets to international trade. First, we will briefly describe the history of the international financial market and list its main roles with regard to international trade. Next, we will discuss the latest financial crisis as an example of how financial market developments may negatively impact companies. Finally, we will discuss issues connected with the free movement of capital and the measures taken against the financing of terrorism and anti-money laundering policies. It would be impossible for international trade to exist without the global financial system, which is a worldwide framework of agreements and institutions, facilitating the exchange of financial capital among entities participating in international investment and trade. The global financial system allows management of the world's balance of payments, which comprises all payments made and received by all countries. An important part of the balance of payments is the current account, encompassing, among others, the balance resulting from international trade. In the global balance of payments, some countries, such as China or Germany, have a current account surplus, meaning that they are net exporters, while countries such as the United States record a current balance deficit, implying that they are net importers. Accordingly, through the global financial system, countries with positive current balance in fact provide financing to countries with negative current balance. Global financial markets evolved in the 19th century in reaction to an increase in international trade, mainly triggered by the import of goods from colonies to metropolises. Since that time, global financial markets have recorded upswings and downturns. The latter were marked with the two world wars and the Great Depression of the 1920s. In more recent times, the years of greatest economic development, that is the 1980s and 1990s, in which the globalization of production accelerated, followed the decisions to free float the exchange rates of the world's major currencies following the oil crisis of the 1970s. Since then, a series of local financial crises took place in many regions of the world, including South America and Asia. These crises resulted in increased financial markets volatility. The last of the crises, which had an impact on global financial markets, was the credit crunch of 2008 and the Eurozone crisis, which started in 2009. Let us now discuss the mechanics and implications of both of these crises. The credit crunch resulted from excessive lending by American banks in the early 2000s. At that time, the American banking industry was over-liquid, and as a result, American banks found themselves pressured to extend loans to customers with a low level of creditworthiness and corresponding low credit rating, referred to as subprime loans. At the same time, a new cheap way of refinancing became available to banks in the form of securitization transactions. In a securitization, a portfolio of assets is sold to an entity referred to as a special purpose vehicle, which then issues debt securities whose risk is connected with the risk of the assets transferred. Such securities are known as CDOs, or collateralized debt obligations. A further mechanism called the tranching of risk made it possible to achieve high external ratings of CDOs, which were purchased by investors worldwide. In 2007 and 2008, subprime loans started defaulting, as a result of which the riskiness of CDOs, even of those tranches with high external ratings, grew dramatically. As a consequence, institutions who had been investing in CDOs recorded massive losses. The direct result of plummeting CDO prices was a near complete breakdown of the interbank financing market, which spread from the United States to other areas of the world, giving rise to a global financial crisis. The aftermath of this crisis included bankruptcies of several globally important financial institutions, some of which were liquidated and some saved by government intervention. What is more, in the years following the crisis, banks in all regions of the world became reluctant to grant loans, making it more difficult for companies to refinance their debts. In order to understand the mechanism which led to the outbreak of the crisis, let's take a closer look at the logic behind securitization. As we have already noted, the SPVs which purchased portfolios of assets from banks issued debt securities that were contractually linked to the credit quality of those asset portfolios. What this meant was that the contractual cash flows of the securities, that is their coupons and principal, would only be paid out if the loans backing those securities were in fact being repaid. In order to make the CDOs more attractive to investors and also to lower the refinancing cost in a securitization, the risk of the asset portfolios was unevenly spread across the different tranches of securities issued by an SPV. Junior tranches were subordinated to more senior tranches, implying that the holders of these subordinated instruments would only be paid off after the holders of more senior tranches had received all payments due. As a result, it was possible for the issuers of such instruments to achieve high external ratings and relatively low credit margin on senior tranches. In typical securitizations, the most subordinated tranche, accumulating the most risk, was in fact retained by the SPV. As one may expect, a securitization transaction functions properly as long as the assets purchased by the SPV generate enough cash flow to service the senior tranches of the CDO. What happened in 2007 and 2008 was a massive increase of credit risk in the assets backing the CDOs, as a result of which SPVs found themselves short of cash to service even the most senior of the tranches. Let us now examine a numerical example of a securitization and tranching. Imagine a portfolio of mortgage loans granted by a bank to its customers. The nominal amount of the portfolio is $100 million, and the assets generate a contractual income of 10% annually. The bank transfers the portfolio to an SPV, which will issue CDOs based on 90% of the portfolio, and the remaining 10% will serve as an additional credit support instrument in the transaction. The SPV will issue a senior tranche of $54 million in nominal value and with a coupon rate of 8%, a mezzanine tranche of $27 million and a coupon rate of 9%, and a junior tranche of $9 million and a coupon rate of 12%. In this transaction, the mezzanine tranche is subordinated to the senior tranche, and the junior tranche is naturally subordinated to the mezzanine tranche. So, the flow of payments in the transaction resembles a waterfall, where the proceeds collected from the loans first flow to the senior tranche, and when all payments due to holders of this tranche have been realized, then the flow is directed further down to the mezzanine tranche. Only what is left after servicing the mezzanine tranche will belong to investors in the junior tranche. Let us assume that all borrowers in the portfolio service their loans according to schedule. In such a case, the portfolio will generate $10 million of interest proceeds, calculated as $100 million of nominal value times the contractual rate of 10%. The senior tranche will receive $4.32 million of interest, calculated as the nominal amount of $54 million multiplied by the coupon rate of 8%. Then the interest on the mezzanine tranche of 2.43 or $27 million times 9% will be paid out. The remainder of the cash collected from the loan portfolio amounts to $10 million of total interest, minus $4.32 million of interest on senior debt, and less a further $2.43 of interest on mezzanine debt, which amounts to $3.25 million, can be paid out to the holders of junior debt. Please note that the $3.25 million represents the securitization's capacity to absorb losses, beyond which investors in the more senior tranches become affected. This capacity amounts to 32.5% or $3.25 million divided by 10 million of the total amount of contractual interest on the securitized assets. Thus, holders of the senior and mezzanine tranches are safe as long as no more than 32.5% of loan borrowers fail to repay their obligations to the bank. The most recent financial shock, which impacted the global financial system, began in Europe in the year 2009 and is commonly referred to as the Eurozone crisis. The origin of the crisis was Greece announcing that its fiscal deficit amounted to 12.7% of the country's GDP, compared to the 3% allowed for countries which adopted the euro as their currency. In consequence, investors started selling Greek treasury bonds, whose prices plummeted. Soon, Greece stood at the verge of bankruptcy. The crisis spread to other Eurozone countries suspected of having problems with budget discipline, such as Portugal, Italy, Spain, and in the later phase of the crisis, also Cyprus. In order to avoid the further spreading of the crisis, the remaining countries of the Eurozone, together with the IMF, decided to bail out Greece and other troubled economies, and the European Central Bank started purchasing their treasury bonds in order to stabilize the situation in the European banking system. Probably the most significant consequence of the Eurozone crisis is the downgrade of many European countries by rating agencies, and the loss of confidence in the European Union, which also indirectly impacted a series of anti-European choices made in elections throughout member states, including the so-called Brexit, that is Great Britain's decision to leave the European Union. Let us now shift our attention to a different issue associated with international trade and the free movement of goods, services and capital in the international economy, namely the risk of using the reduced barriers to trade in order to remit funds for criminal purposes. On the one hand, the elimination of restrictions, in particular those associated with the free movement of capital, is a cornerstone of the global economy. On the other hand, however, it offers opportunities for criminals to pursue illegal activities, such as the financing of terrorism and money laundering. The term money laundering refers to a situation where illicitly obtained funds or assets are entered into the financial system as a way of concealing their link with crime. In recent years, global leaders have been working to adopt measures that would help identify and eliminate financial flows resulting from criminal activity. In 1989, the Financial Action Task Force, referred to as FATF, was established, which formulated recommendations on legal solutions aimed at the elimination of money laundering. According to these recommendations, companies have an obligation to monitor payments which they make and receive in order to ensure that they are not made in connection with criminal actions, and to report all suspicious cases to the local financial investigation unit. Participation in the remittance of funds coming from criminal activities, possession of and dealing with such funds, as well as concealing knowledge regarding such transactions by a company, are all considered a participation in crime. Anti-money laundering and anti-terrorism financing legislation has been implemented in most countries. An example of such legal acts is the Anti-Money Laundering Directive of the European Union. The ALM Directive, as it is referred to, generally fulfills the FATF recommendations. Its provisions impose a number of requirements on accountants of entities participating in the financial system, including, among others, identification of each client, reporting of all suspect financial activities, adequate record keeping in relation to transactions, and customer due diligence procedures.